Well, the street is closely watching out for what engineering conglomerate L&T delivers by way of its quarterly numbers. Now, here's what the street is penciling in for Q4 FY22. This time around, the profits are seen coming in higher by about 15% to 3,788 crore rupees. This is versus 3,292 crores last year. The revenue growth, which is the key monetable, is expected to come in high by about 13%, 54,395 crore rupees versus about 48,087 crores is what the ET Now poll suggests. Now, do remember the revenue growth is likely to be led by growth in IT, infrastructure segments, and even hydrocarbon, and that's largely on the back of higher execution as well as billing, and it's a seasonally strong quarter as well for the company. Now, in terms of the Ebitda, we're penciling in an absolutely flattish Ebitda at about 6,598 crore rupees versus 6,388 crores on a year-on-year basis. The margins this time around are seen contracting. So we're expecting close to 12.1% in terms of their margins in Q4. This is versus about 13.2% on a year-on-year basis. Now, the margin contraction on a year-on-year basis is largely on account of the fact that there has been increase in input costs, and that's particularly for the fixed price contracts that the company has faced. But if we look at it from a quarter-to-quarter basis, we're expecting margins to expand, and that's largely on account of the operating leverage. Remember, there is also an expectation of higher revenues and the cost-saving initiatives that the company has been taking. When it comes to the order inflow, that's also closely monitored by the street. It's expected at about 70,000 to 80,000 crore rupees. Remember, the company has been at the receiving end of a whole host of orders as well of late, and that is building into the low to the mid-teen order inflow growth guidance that had been given by the company. Let's talk about the individual segments and what the street is penciling in. Now, when it comes to the infrastructure growth, that's seen higher by about 8% on a year-on-year basis. The defense segment could see growth declining by about 11%. Hydrocarbon revenues, they're seen absolutely flat, growing by just about 3% on a year-on-year basis. The E&C segment revenue growth is expected to come higher by about 10% on a yearly basis. That's led by the sturdy execution of the company's order book, and the services business is seen growing smartly by about 24% on a year-on-year basis. The street is also going to monitor the working capital, the commodity cost impact, as well as the cash flow management. Those are going to be some of the key monitorables. Now, when it comes to guidance, we have been used to traditionally every quarter L&T giving out their guidance, but they've refrained from doing so over the past many quarters on account of the uncertain environment due to the pandemic. So in the last quarter, the company did say that they are positive on the order pipeline, but they have flagged off timeline concerns. They've also said that they are hopeful to maintain a strike rate of 15 to 20% that the company has historically. And in Q2, the company as well had flagged off they are confident that they will meet the FY22 guidance of low to mid-teen growth when it comes to orders and revenues. So we'll have to wait and watch as to whether or not the company gives any sort of guidance as well for going ahead. But for now, that's what the street is expecting from L&T.